Welcome back to another Teaching Tuesday. My name is Blake Bagshaw here with Sims Investment, and in today's video we're going to be discussing common mistakes that investors make and how to avoid them. Avoiding common investing mistakes is key to building long-term wealth and achieving the financial goals that you have. The following are a couple common mistakes that we see investors make. The first one is not having a plan and not sticking to it. The mistake is investing without clear goals or a strategy. You can avoid this by defining your goals, such as what do you want retirement to look like? Buying a home here soon, wanting to save for your kids' education. Another one is choosing investments that align with your risk tolerance, time horizon, and objectives. And lastly, reviewing your plan regularly and updating it as life changes. The second mistake is trying to time the market. This mistake is jumping in and out of investments based off market headlines. You can avoid this by staying invested consistently, even during downturns. Heck, even viewing downturns as buying opportunities. Another strategy is using dollar cost averaging, which is investing a fixed amount regularly to reduce the timing risk. A fun fact here, assuming that you had all of your money invested in the S&P 500, over the last 30 years, if you had missed the best 10 days in the market, your market returns would be cut in about half. You can look at the graphs below, which are very eye-opening. And this is why that we're big on, it's more about being time in the market than trying to time the market, especially when it comes to long-term assets. Number 3, not diversifying your portfolio. Mistake here, putting all your money in one stock, sector, or trend. Kind of like the whole don't put all your eggs in one basket. That plays here. You can avoid this by spreading your investments across asset classes such as stocks, bonds, international, small caps, large caps, etc. The next one is using low-cost funds such as ETFs for broad diversification. Number 4, and I think this one is very important, is not managing your emotions. The mistake here is trying to sell during market drops or buying into the next big hype. For example, meme stocks or the latest crypto frenzy that's out there. Avoid this by sticking to your plan, unless your goals have changed, which if that's the case, you should be reaching out to your advisor and having a more in-depth discussion. Also, remembering, investing is a long-term game, not a short-term reaction. Don't make short-term decisions with long-term money. And lastly, not starting early and staying consistent with our investing plan. Avoiding this by starting today. You know, we all wish, hindsight's 2020, we all wish we would have started investing earlier in life and reap the rewards of compound interest. But starting small, even if it's just a little bit here and there, start as soon as you can. And when you do start, automating contributions, whether that's on a weekly basis or a monthly basis or semi-annually, however it works for you, but staying disciplined to that saving strategy will really help you meet your financial goals. One final thought here is that successful investing isn't about brilliance. It's about behavior. Stay focused, stay diversified, and most importantly, stay the course. If you have had any questions about what was mentioned in this video or have any other questions in general, please reach out, as we're always here to help. Thanks so much, and we'll see you next week.